$8,200. That's what's staring back at me from my phone screen right now. And here's the really messed up part. I put $5,000 into this account 18 months ago, and then I just forgot about it. Not on purpose. I was too terrified to look. You know that feeling when you do something that could either be the smartest decision of your life or the dumbest? That stomach drop moment where you hit submit on something and immediately want to take it back? That was me. 18 months ago. Lying in bed at 3 a.m., my finger hovering over the deposit button for a robo-advisor account I'd spent 6 weeks researching, but was absolutely convinced would somehow lose all my money. $5,000 doesn't sound like a lot to some people. But to me, that was every dollar I could scrape together after years of failed stock picks, crypto disasters, and keeping way too much cash in a savings account that paid 0.01% interest, while inflation ate it alive. That $5,000 represented something bigger than money. It represented my willingness to trust something I didn't fully understand. I hit deposit. Then I closed the app. I didn't look at it for 3 months. When I finally opened it again, my hands were shaking. I was convinced I'd see $4,000 or less. Some fee I didn't know about, some market crash I missed. Some stupid mistake that proved what I'd always suspected. I wasn't meant to be good with money. But it said $5,312. I stared at it for probably 10 minutes. Then I closed the app again and didn't open it for another 6 months. Because here's what nobody tells you about investing. Sometimes the scariest part isn't losing money. It's the possibility that you might actually be doing something right. So today, 18 months later, I'm forcing myself to look at this account. And it says $8,200. That's a $3,200 gain from doing absolutely nothing. From checking it maybe 3 times total. From not panic selling when the market dipped. From not second-guessing every decision. From just letting it sit there and do its thing. And I have no idea how it happened. Like, intellectually, I know it's investing and compound growth and market returns. But emotionally, it feels like magic. Which is exactly why I need help understanding what's actually going on. Because if I'm going to do this long-term, if I'm going to actually build wealth instead of just getting lucky once, I need to understand the machine. Cipher materializes. Small holographic form floating to Vera's right, semi-transparent cyan and purple glow, approximately 40% of Vera's image size. This is Cipher, my AI financial assistant. I know how that sounds. But here's the thing, I've spent years trying to figure this stuff out on my own, and all I did was paralyze myself with information overload. I'd read 10 articles about index funds and end up more confused than when I started. I'd watch videos about diversification and come away thinking I needed a PhD in economics to invest. So I thought, what if I had someone who could actually explain this stuff to me? Not in finance bro language, not in textbook terms, but in a way that makes sense to a 30-year-old woman who's terrified of making the wrong decision. Someone who could show me the data without making me feel stupid for not understanding it the first time. Cipher displays. Account timeline. Holographic graph showing the $5,000 initial deposit at month 0. Gentle upward trend line with minor fluctuations, ending at $8,200 at month 18. Okay. So that's what happened. But what does it mean? Because when I look at that graph, I see $3,200 that appeared from nowhere. But that's not actually what happened, is it? Something was working in the background. Some algorithm, some strategy, some process I trusted without understanding. And here's where I need to be honest with you. I almost didn't do this. I almost kept that $5,000 in my savings account earning basically nothing. I almost talked myself out of it with the same story I'd been telling myself for years. I don't know enough yet. I need to learn more first. I need to wait until I really understand it. But that's just fear dressed up as prudence. That's just another way of saying, I'm so scared of doing it wrong that I'd rather do nothing at all. And doing nothing? That's its own kind of risk. That's the opportunity cost that nobody talks about. Every day I didn't invest was a day I lost to inflation. Every month I waited was a month of potential growth I'd never get back. So I want to understand what this robo-advisor actually did with my money. I want to know why it worked. I want to see the mechanics behind the magic. Because if you're sitting there right now with money in a savings account, paralyzed by the same fear I had, maybe seeing what happened to my $5,000 will give you permission to take the first step. Maybe seeing that I didn't need to be an expert will help you realize you don't either. Maybe understanding that the algorithm did the work while I slept will show you that you don't have to become a day trader to build wealth. Maybe knowing that I checked this account 3 times in 18 months and it still grew will prove that obsessively monitoring your investments isn't what makes them successful. Let me paint you a picture. 18 months ago, I was someone who kept $5,000 in cash because I was too scared to invest it. Today, I'm someone sitting here with $8,200, finally ready to understand how it happened. That transformation didn't require me to become a different person. It just required me to start. Cipher displays. Simple equation hologram. Initial investment plus time plus algorithmic strategy equals growth. So let's break this down. Let's figure out what a robo-advisor actually is. Let's understand what happened to my money while I wasn't looking. And let's see if we can turn this accidental success into an intentional strategy. Because if this worked once by accident, imagine what could happen if I actually understood the process. Sound familiar? That mix of hope and terror? That feeling that you're one decision away from either building wealth or making a huge mistake? Yeah. I've been there. I'm still there sometimes. But the difference now is that I have data. I have results. I have proof that doing something imperfect is better than doing nothing perfect. And I'm going to show you exactly how it happened. Let me take you back before the robo-advisor, back before the $8,200, back to when I thought I was being smart with money but was actually bleeding opportunities every single day. I had $12,000 sitting in a savings account, just sitting there, earning 0.05% interest while I congratulated myself for being responsible, for not being one of those people who blows their money on stupid stuff, for having a safety net, except that safety net was actually a slow-motion financial suicide. Here's what nobody tells you about cash. It feels safe until you do the math. It feels responsible until you realize that inflation is eating it alive. It feels smart until you understand that every day you're not investing is a day you're actually losing money. But I didn't want to see that. I wanted to believe that doing nothing was the same as doing something. Cipher displays. Floating beside Vera at 40% her size. Holographic calculation showing $12,000 losing approximately $240 per year to 3% inflation. Yeah, that hurt to see. $240 a year just evaporating. Not because I spent it, not because I made a bad investment, but because I was too scared to do anything. Because I convinced myself that keeping cash was the safe choice when it was actually the riskiest thing I could do. But it gets worse. Because I didn't just keep my money in cash. Oh no, I also tried to be a stock picker. I read the articles, I watched the videos, I joined the Reddit communities. I convinced myself that if I just researched enough, if I just learned enough, I could beat the market. I could be one of those people who turns $10,000 into $1 million. So I bought individual stocks. Tesla because everyone was talking about it. Some biotech company because I read a convincing post about their new drug trial. A gaming stock because I liked their products. And you know what happened? I lost $2,300 in 8 months. Not because the companies were bad, but because I had no idea what I was doing. Because I was making emotional decisions based on Reddit hype and FOMO. Every time a stock went down, I'd panic and sell. Every time a stock went up, I'd hold it too long hoping it would go higher. I was letting fear and greed make every decision. I was checking my portfolio 6 times a day, feeling physically sick when I saw red numbers. I was lying awake at 3 a.m. wondering if I should cut my losses or hold on. It was exhausting. It was toxic. And it was completely unsustainable. Cipher analyzes. Small hologram displaying Vera's trading pattern over 8 months, showing frequent buys at peaks and panic sells at valleys, highlighting the classic emotional investing cycle. Look at that. Every single decision I made was wrong because every single decision was emotional. I bought high because I was excited. I sold low because I was scared. I was the perfect example of why individual investors underperform the market. Not because I was stupid, but because I was human. And here's the really messed up part. After I lost that $2,300, I didn't learn to invest better. I learned to not invest at all. I went back to keeping everything in cash. I told myself I wasn't ready. I told myself I needed to learn more. I told myself that investing was for people who understood finance, not for someone like me. I spent 6 months reading articles about index funds, 6 months watching videos about diversification, 6 months paralyzed by analysis. Because here's what happens when you're scared. You convince yourself that more information will make you less scared. You think that if you just read one more article, watch one more video, understand one more concept, then you'll be ready. But you're never ready. You just get better at finding reasons to wait. My dad called me one Sunday. He asked how my investments were going. I told him I was still researching options. He said something that made me want to throw my phone across the room. "You've been researching for 2 years. At some point, you have to actually do something." I hung up, angry, because he was right and I didn't want to admit it. That night, I did something I'd been avoiding. I calculated my opportunity cost. I looked at what would have happened if I'd invested that $12,000 2 years earlier, instead of keeping it in cash and making emotional stock picks. I used a basic market return calculator, 7% average annual return. Nothing fancy, just the historical average. Cipher displays. Holographic projection showing 2 timelines side by side. Timeline 1 shows Vera's actual path with cash and failed stock picks, resulting in $9,700 after 2 years. Timeline 2 shows what $12,000 invested in a diversified portfolio would have become. $13,768, $4,068. That's what my fear cost me. $4,068 that I lost not to a bad investment, not to a market crash, not to fees or scams. I lost it to paralysis. I lost it to the belief that doing nothing was safer than doing something imperfect. I lost it to waiting for the perfect moment that never comes. You know that feeling when you realize you've been your own worst enemy? When you see clearly that the thing holding you back wasn't circumstances or bad luck or lack of knowledge? It was you. It was the story you kept telling yourself. It was the fear you dressed up as prudence. It was the perfectionism you mistook for responsibility. That's when something shifted. I realized that my relationship with money was toxic. Not because I didn't have enough, not because I made bad decisions in the past, but because I let fear make all my decisions. I let the possibility of being wrong paralyze me into definitely being wrong. I let the risk of losing money prevent me from the certainty of building wealth. So I made a decision, not a perfect decision, not a fully informed decision, not a decision I was completely comfortable with, but a decision. I was going to take that $5,000 I'd scraped together and I was going to invest it, not in individual stocks where my emotions could sabotage me, not in some complicated strategy I didn't understand, but in something that would remove my ability to panic sell and second guess. I was going to let an algorithm do what I couldn't, make consistent, unemotional, data-driven decisions. I was going to automate the thing I kept screwing up manually. I was going to admit that my biggest problem wasn't lack of knowledge. It was too much emotion. And maybe, just maybe, the solution wasn't to become smarter. It was to get out of my own way. Okay, so I have $8,200. I started with $5,000. That's a $3,200 gain in 18 months. But here's what's driving me crazy. I have no idea what actually happened. Like, where did that money come from? What did this algorithm do that I couldn't do myself? Because here's the thing. When you invest in individual stocks, you kind of understand it. You buy Tesla stock, Tesla does well, your stock goes up. Simple. Terrible strategy for most people, but simple. But with a robo-advisor, it's like putting your money into a black box and hoping it comes out bigger. And I hate not understanding how things work. So I'm going to do something I should have done 18 months ago. I'm going to ask Cipher to show me exactly what happened to my $5,000. Not in finance textbook language, not in terms that require a degree to understand, but in a way that actually makes sense. Because if I'm going to keep doing this, if I'm going to invest more money, I need to understand the machine. Cipher displays. Small holographic form floating to Vera's right at 40% her size, bringing up a visualization showing the $5,000 initial deposit splitting into multiple streams. Okay, so that's what happened immediately. My $5,000 didn't stay as one big chunk, it got divided up. And this is where I need Cipher to break this down for me, because this is the part I never understood. Why split it up? Why not just pick the best investment and put everything there? Cipher displays. Holographic pie chart showing asset allocation. 60% stocks across different sectors and countries, 35% bonds, 5% cash reserves. So my money got split into stocks, bonds, and a tiny bit of cash. Stocks are the risky growth part. Bonds are the stable, boring part. Cash is the emergency buffer. And here's what I'm starting to understand. This isn't about picking winners. This is about spreading risk. This is diversification. But let me get more specific, because diversification is one of those words people throw around without explaining what it actually means. When Cipher shows me the stock portion, it's not like I own 10 stocks. I own thousands of them, through something called index funds. And this is where it gets interesting. Cipher analyzes holographic display breaking down the stock allocation into specific index funds tracking different markets. U.S. large companies, international developed markets, emerging markets, small cap companies. So instead of me trying to pick the next Tesla or Apple, I'm basically owning tiny pieces of everything. When I invested that $5,000, I automatically became a partial owner of thousands of companies across dozens of countries. Tech companies in California, manufacturing companies in Germany, banks in Japan, retailers in Brazil, all at once. And here's why that matters. When I was picking individual stocks, if one company tanked, I lost big. Remember that biotech stock I mentioned? Lost 62% of that investment when their drug trial failed. But with index funds, if one company fails, it's like 0.001% of my portfolio. It barely registers. The winners carry the losers. But it's not just about protection from losses. It's about capturing growth wherever it happens. Because here's what I learned the hard way. Nobody knows which sector will do best in any given year. In 2023, tech stocks crushed it. In 2022, they got destroyed. If I'd tried to time that, I would have been wrong. But by owning everything, I captured the gains no matter where they came from. Cipher displays holographic timeline showing automatic rebalancing events over 18 months, small adjustments happening quarterly. Wait, what's that? Rebalancing? Okay, Cipher, explain this, because this looks like the algorithm was making changes without telling me, and that makes me nervous. Cipher displays side-by-side comparison showing target allocation, 60% stocks, 35% bonds, 5% cash, versus actual allocation after 3 months, 64% stocks due to growth, 31% bonds, 5% cash. Oh, so when stocks did well, they grew to be a bigger percentage of my portfolio than planned. And rebalancing means the algorithm automatically sold some of the stocks that went up and bought more bonds to get back to the target mix. Which sounds crazy at first. Why would you sell the thing that's winning? But here's what makes sense about it. It's the opposite of what I used to do. Remember how I'd hold winning stocks too long hoping they'd go higher and sell losing stocks in a panic? Rebalancing does the exact opposite. It forces you to sell high and buy low. Automatically. Without emotion. Without second guessing. It's like having a robot that does the rational thing even when the rational thing feels wrong. And this is where I'm starting to see why algorithmic investing works. It's not because algorithms are smarter than humans. It's because they're more consistent. They don't panic. They don't get greedy. They don't lie awake at 3 a.m. wondering if they should sell everything. They just follow the rules, over and over and over. Cipher displays holographic comparison showing how ChatGPT would explain index investing versus how Claude would break it down. This is interesting. Cipher is showing me how different AI assistants would explain the same concept. ChatGPT gives you this long, detailed explanation with historical context and academic research. It's thorough, but it's overwhelming. You finish reading and you're more confused than when you started because there's too much information. Claude takes a different approach. It breaks it down into a simple analogy. Imagine you're betting on a horse race, but you don't know which horse will win. The smart strategy isn't to pick one horse and hope. It's to bet a little bit on every horse. You won't win big on any single race, but over time you'll capture the average performance of all the horses. That's index investing, and that analogy finally makes it click for me. I wasn't trying to pick the winner. I was trying to capture the average. And the average, over time, goes up. Not every day, not every month. But zoom out far enough and the trend is clear. The market grows because innovation grows. Because companies create value. Because the economy expands. So when I put $5,000 into this robo-advisor 18 months ago, I wasn't making a bet on one company or one sector or one strategy. I was making a bet on human progress. On the idea that over time, businesses will figure out how to create more value, serve more customers, solve more problems. And that bet paid off. $3,200 so far. But here's what I'm realizing. The algorithm didn't do anything magical. It did something simple. It bought a diversified portfolio. It rebalanced when needed. It ignored the noise. It followed the rules. And that simplicity is what made it work. Because the enemy of investing isn't complexity, it's emotion. And the algorithm removed emotion from the equation. That's what was happening while I wasn't looking. That's the machine behind the magic. And suddenly, $8,200 doesn't feel like luck anymore. It feels like the natural result of a process. A process I can trust. A process I can repeat. Here's something I need to confess. I only checked this account 3 times in 18 months. 3 times. And I know what you're thinking because it's what I thought too. That's irresponsible. That's not being engaged with your money. That's being careless with $5,000. Except here's what actually happened. Those 3 times I didn't check, that was the secret weapon. That was the thing that made this work. Because every time I checked my individual stock picks, I made a bad decision. Every single time. I'd see red numbers and panic sell. I'd see green numbers and get greedy. My emotions hijacked every decision. But with the robo-advisor, I set it up, deposited the money, and then I was too scared to look. For 3 months. And when I finally checked, it had grown. Not by much, $312. But it had grown. And instead of feeling relieved, I felt terrified because now I had something to lose. So I closed the app again. I didn't check for another 6 months. And this is where it gets interesting. Because during those 6 months, the market went down. I didn't know it was happening. I didn't see the red numbers. I didn't feel the panic that would have made me sell. I just kept living my life while the algorithm did its thing. A cipher displays. Holographic graph showing market volatility over 18 months, highlighting 3 specific periods where Vera would have panic sold if she'd been watching daily. Look at that. 3 separate times the account dropped below my initial $5,000. If I'd been checking daily, if I'd been watching those numbers go down, I would have sold. I know I would have. Because that's what I did with my stock picks. I couldn't handle watching money disappear, even temporarily. But because I wasn't watching, the algorithm just kept rebalancing, kept buying more when prices were low, kept following the strategy, and when the market recovered, which it always does eventually, my account recovered with it. Except now I owned more shares because the algorithm had been buying during the dip. Cipher analyzes side-by-side behavioral data showing average investor returns versus market returns over 10 years, revealing a 3% annual gap due to emotional decision-making. This is brutal. Cipher is showing me that the average investor underperforms the market by about 3% per year, not because they pick bad investments, but because they buy high when they're excited and sell low when they're scared. They let their emotions destroy their returns, and I was the perfect example of that. When I was actively managing my stock picks, I checked my portfolio 6 times a day. 6 times a day I was making myself anxious. 6 times a day I was second-guessing decisions. 6 times a day I was looking for reasons to buy or sell based on how I felt in that moment. But with the robo-advisor, I checked 3 times in 18 months. That's once every 6 months. And you know what happened during those months I wasn't checking? My brain wasn't treating it like money anymore. It wasn't real. It was this abstract thing that existed somewhere in the cloud. And that psychological distance was exactly what I needed. Cipher displays. Comparison showing how ChatGPT would explain risk tolerance versus how Claude would approach the same concept. Okay, this is fascinating. Cipher is showing me how different AI assistants would explain why not checking your account works. ChatGPT gives you this long explanation about loss aversion bias and prospect theory and behavioral economics. It cites studies and research papers and historical data. It's accurate, but it's overwhelming. Claude breaks it down differently. It asks you to imagine you planted a seed in your backyard. Would you dig it up every day to check if it's growing? No, because digging it up would damage the roots. You water it, you give it sunlight, and then you leave it alone. Checking your investments daily is like digging up the seed. You're not helping. You're just creating opportunities to panic. That analogy hits different, because that's exactly what I was doing with my stock picks. I was digging up the seed every day. I was damaging my own returns by checking too often, by giving myself too many opportunities to make emotional decisions. And here's what I'm starting to understand about algorithmic investing. It's not about the algorithm being smarter than me. It's about the algorithm not having emotions. It doesn't feel fear when the market drops. It doesn't feel greed when the market spikes. It just follows the rules. Buy low, sell high, rebalance when needed, ignore everything else. Cipher displays. Holographic timeline showing Vera's 3 account checks overlaid with market performance, revealing she happened to check during neutral or positive periods by pure luck. Wait, so I got lucky? The 3 times I checked, the account happened to be doing okay or better? If I'd checked during one of those dips, would I have panicked and sold? Yeah, probably, definitely, and I would have locked in losses that would have recovered if I'd just waited. This is the part that makes me uncomfortable. Because I want to believe I'm rational. I want to believe I make logical decisions based on data. But the truth is, I'm not rational when it comes to money. I'm emotional. I'm reactive. I make decisions based on how I feel in the moment, not on long-term strategy. And maybe that's okay. Maybe the solution isn't to become more rational. Maybe the solution is to acknowledge that I'm emotional and build systems that protect me from my own emotions. That's what the robo-advisor did. It removed my ability to make emotional decisions. It automated the rational choice. Cipher asks, holographic question display floating beside Vera. How often do you think you should check long-term investments? Cipher is asking me a question, and I know the answer now. As little as possible. Maybe once a quarter if you need to feel engaged. Maybe once a year if you can handle the uncertainty. But definitely not daily. Definitely not every time you feel anxious. Because every check is an opportunity to make an emotional decision that hurts your long-term returns. You know what's crazy? The less I engaged with this account, the better it performed. Not because ignoring it made it grow, but because ignoring it prevented me from sabotaging it. Every time I didn't check was a time I didn't panic sell. Every month I forgot about it was a month the algorithm could do its job without my interference. So when people ask me how I turned $5,000 into $8,200, the honest answer is, I did nothing. I set up the account, deposited the money, and then I got out of the way. I let the algorithm be rational when I couldn't. I let time do the heavy lifting. I let consistency compound. And that's the power of not checking your account. It's not about being careless. It's about being strategic. It's about recognizing that your biggest enemy as an investor isn't market volatility. It's your own emotions. And sometimes the best way to win is to remove yourself from the game and let the algorithm play for you. So here's where I am now. 18 months after that terrifying night when I hit deposit. 18 months after I convinced myself I was about to lose everything. I'm sitting here with $8,200 and a completely different relationship with money. But more importantly, I understand something I didn't understand before. This isn't about the $3,200 I gained. This is about proving to myself that I can do this, that I don't need to be an expert, that I don't need to time the market perfectly, that I just need to start and then get out of my own way. And I want to show you something. Because if $8,200 feels good, you need to see what happens when you keep going. When you don't just invest once and forget about it. When you make this a system instead of a one-time decision. Cipher displays. Holographic projection showing 3 timeline scenarios. $8,200 left untouched for 10 years at 7% average return equals $16,140. For 20 years equals $31,660. For 30 years equals $61,990. Look at that. If I literally do nothing for 30 years, that $8,200 becomes almost $62,000. Just from time. Just from compound growth, just from staying invested and not panicking. That's the power of leaving it alone. But here's what gets really interesting. What if I kept adding to it? What if I invested another $500 every month? Not a huge amount, not some unrealistic number, just $500. Less than most people spend on eating out and entertainment. Nifty. Cipher analyzes. Holographic calculation showing monthly contributions of $500 plus the existing $8,200 over 30 years at 7% average return, resulting in $631,000. $631,000. That's what happens when you combine time, consistency, and compound growth. That's what happens when you automate good decisions. That's what happens when you remove emotion from the process and just let the system work. And I need you to understand something. I'm not special. I didn't discover some secret strategy. I didn't get lucky with timing. I just did the most boring thing possible. I invested in a diversified portfolio, and then I left it alone. That's it. That's the whole strategy. So let me break down exactly what I learned, the specific lessons that changed how I think about money. Not theory, not concepts, but actual insights that I can use every day. Lesson 1. Perfection is the enemy of wealth building. I wasted 2 years trying to learn everything before I started. 2 years of opportunity cost because I was scared of making a mistake. But the biggest mistake was waiting. The best time to start was 2 years ago. The second best time is right now. Lesson 2. Your emotions are the biggest risk to your portfolio. Not market crashes, not recessions, not bad investments, your panic selling, your FOMO buying, your constant second guessing. The algorithm removed my ability to sabotage myself, and that was worth more than any market insight. Lesson 3. Checking your account less often improves returns. This sounds crazy, but the data proves it. Every time you check is an opportunity to make an emotional decision. Every login is a chance to panic. The less I engaged with the account, the better it performed. Lesson 4. You don't need to understand everything to start. I still don't fully understand modern portfolio theory or efficient frontier optimization. But I understand enough. I understand diversification reduces risk. I understand index funds capture market returns. I understand time is my biggest advantage. That's enough to begin. Lesson 5. Set and forget is not lazy. It's strategic. For years I thought active management meant I was being responsible, but constant tinkering was destroying my returns. Setting up a system and then trusting it isn't passive. It's disciplined. It's removing human error from the equation. Cipher displays. Holographic list showing Vera's specific action steps taken over 18 months. Step 1. Set up robo-advisor with risk assessment. Step 2. Automated monthly deposits even when small. Step 3. Limited account checks to quarterly reviews. Step 4. Ignored market news and social media hype. Step 5. Reinvested all dividends automatically. Those 5 actions. That's what I did. Nothing complicated. Nothing that required special knowledge or perfect timing. Just 5 simple decisions that compounded over 18 months. And the result is sitting right here in front of me. $8,200 from $5,000. But here's what I want you to hear. If you're sitting there right now with money in a savings account, paralyzed by the same fear I had, you don't need to know everything before you start. You don't need to wait until you feel ready. You don't need to become a financial expert. You just need to take the first step. Maybe that's opening an account today. Maybe that's depositing whatever you can afford, even if it's just $1,000. Maybe that's setting up automatic transfers so you can't talk yourself out of it. Maybe that's making a promise to yourself that you won't check it every day. Whatever your first step is, take it. Because waiting for perfect is the same as choosing never. Cipher shows holographic projection of Vera's potential account value if she maintains current trajectory for 5 more years, approximately $22,000. 5 years from now, if I just keep doing what I'm doing, I'll have over $22,000. 10 years from now, over $50,000. 20 years, over $200,000. Not from getting rich quick, not from picking the right stock, not from timing the market, just from starting and not stopping. You know that feeling I described at the beginning? That stomach drop terror of hitting deposit? I still remember it. But you know what's stronger than that feeling? This one. The feeling of seeing $8,200 and knowing I built it. The feeling of understanding that I'm not a victim of my circumstances, I'm the architect of my future. So here's my challenge to you. What's your $5,000? What's the amount sitting in your savings account right now that you're too scared to invest? What's the number that feels big enough to matter, but small enough that losing it wouldn't destroy you? Find that number, and then ask yourself, what scares you more? The possibility of making a mistake? Or the certainty of missing out on 18 months, 5 years, 10 years of compound growth? Because here's what I know now. The market will be volatile. There will be days, weeks, maybe months where your account goes down. But over time, the trend is up. Over time, diversification works. Over time, staying invested wins. Not every time, but most times. And most times is enough. I'm not telling you this is easy. I'm not telling you the fear goes away. I'm telling you that action cures fear. That doing something imperfect beats doing nothing perfect. That the best investment you can make is in your own willingness to start. 18 months ago, I had $5,000 and a belief that I wasn't meant to be good with money. Today I have $8,200 and proof that I was wrong. And if I can do this, if someone who lost $2,000 on emotional stock picks and kept $12,000 in cash can figure this out, then you can too. You just have to start. Right now, today. Before fear talks you out of it again.